Something I enjoy doing on this channel is really taking what's going on in the media and helping to hopefully translate it to you in kind of simple terms. And what we're going to do here in this conversation is highlight for you that all of the commercial pain that is certainly out there is not the next generation banking crisis 2.0. And we're going to have this conversation with Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. This is going to be a fun one.
Yeah. So over the last year or so, you and I have correctly warned, and frankly, it might have been 18 months, that there is a reckoning coming to LPs in the syndication space, the commercial space. We've talked about office. We talked about multifamily. There was just dumb money chasing dumb deals, and they were ripe to blow up. What is now happening in the media, because this is becoming a reality, is people are going GFC 2.0, banking crisis 2.0, government bailout 2.0. And I just don't see it. I don't think people understand where the pain is. And I think we need to talk about it. What do you think?
Yeah, absolutely. So, you know, there's this idea that, in economics and in warfare, you're always fighting the last war, right?
Yep.
So, just like after World War II, and the US had to fight two wars at the same time, planning for everything in the future became the ability to fight two wars at the same
Multiple
time.
fronts. Yeah.
And the US never fought they're not two major wars again at the same time ever, right? They fought some minor wars at the same time, but not all out mobilization against two industrialized superpowers, like they did in World War II. And every recession, you wind up with people being concerned about the last recession, and they never play out the same way, right? So
Yeah.
after the great financial crisis, there were banking reforms instituted that pretty much changed the way that banks lent money to people who were, investing in real estate.
Mm-hmm.
Banking restrictions the standards got high, tougher. More was required from borrowers, and the banks are frankly just in a better position than they were, at least vis-a-vis real estate,
Mm-hmm.
than at the time of the financial crisis, where they had all convinced themselves that they couldn't lose, and what did they need to protect themselves for? So it's really not, going to wind up where the bulk of the pain is coming from the banks. Or let's rephrase this: when properties get foreclosed on, we know that the equity gets wiped out, right? So the equity definitely suffers pain, but the banks are suffering a lot of pain in that situation. Last time around, we had this raft of foreclosures, right?
Mm-hmm.
This time, I agree with you. I don't think it's going to happen. And the reasons are twofold. One is that banks just did not allow the borrowers to get as leveraged as they were. So there's more cushion, right?
Yep.
There's much more cushion between, the original purchase price and where the lender sits in the capital stack, right? So it's now usually for commercial properties at a minimum 20%, but usually more like 25 or 35%, because the banks learned their lesson. And if you looked at 35% number in particular, it's like, hey, in the Great Recession, commercial property kind of lost on average about 35% of its value, right? Mm-hmm. So therefore, it's the LPs who the bank is going to set up to absorb, what's called the first dollar of loss, right, before you get into so the lenders are pretty well protected against getting into that foreclosure situation, except obviously in office. And look, now you're even having the counter story about office coming out. I'm sure you've seen this, where there's a lot of people saying, hey, this isn't as bad as everybody predicted, but even if it is, the lenders in office might take a bath, but in multifamily, you're just not going to see the same thing. And on top of the fact that there's more cushion required, the banks also got smart after the last time around, right? They're not going to wholesale foreclose on property and just flood the market with it like they did last time, which just exacerbates the problem, right? They're going to extend and pretend as much as possible with strong players or properties that they think are good, or where they see, hey, this is just an issue of rising interest rates, but the operation itself is fine and they can grow their way out of this. Those loans will probably get extended. The ones that are going to be foreclosed on are where you have like really problematic sponsors who don't know what they're doing. There's no chance of them rescuing the deal. and a lot of the problems are of their own making as opposed to the market's making. Those kinds of deals will get taken away from sponsors, but they're not going to be flooded. The market's not going to be flooded. The banks will be going, with the help of brokers who know the markets they'll be targeting the buyers, right? I mean, they're going to be going to the buyers who they know can take these deals over.
That's one of my thoughts on this. And I have a couple, but we'll go here first. All right. There are clearly troubled operators. You and I've said for a year now, the top 10 buyers in, their Rolodex, they're going to get a phone call and say, hey, you want this one? You want this one? We'll do a sweetheart deal. We want this one. But there's still going to be a lot of pain. What's really interesting to me is you and I have been highlighting, or at least I have, and I think you've been a part of this, is a lot of the nonsense that has happened in the commercial financing space is exactly what happened in residential last time. Short-term debt, variable rate debt, people were doing financial engineering and rolling in all of these things. It's called different, right? It's bridge debt versus, ARMs and all of those things. And the other thing I want to say is there's going to be plenty of pain in the commercial market, plenty of pain, maybe pain bigger than last time in totality. However, the banks won't bear the brunt of it. That's what people don't understand. They hear this pain, they hear us talk, they go, hey, if that's true, we got banking 2.0, we're going to do more bailouts, we're going to do all. No, the LPs are going to get whacked. Because again, the equity structure is different in a commercial deal. Worst case, there's 20% equity. Back in the day in single family homes, it was negative, right? They did 100% loan. They did 103% loans. There was no equity. So the banks took all of the pain. The banks aren't going to take all the pain.
In commercial too, the last time around, there was a lot less equity in deals. And the banks had allowed people to put mezz debt
on, that's right.
On deals, right? So it was very common. And I remember when I first started in the business, right after the crash, but before the banking industry really got reformed itself, I had mortgage brokers coming to me saying, hey, I can get you 93% leverage on deals. And I was like, why would I want 93%?
Who would want that?
Yeah, like why would I want that? But I mean, because I wasn't interested in financially engineering my deals. I was thinking about the risk involved. But what they were doing was they were getting their traditional financing, and then they were layering on mezz, sometimes more than one layer of mezz, right? So, you had senior mezz and junior mezz on, below your permanent debt to get you up to this 93%, financing. Banks don't allow that anymore. I mean, if you try to do that now, you'll be in breach of your loan covenants and your guarantees, right? And your non-recourse debt will become full recourse to you if you do that. Ooh, so they nipped that in the bud, right? I mean, they got rid of that. And where was that money coming from, that mezz stuff? Well, that was coming from other lenders, right? So it wasn't just that, well, the banks, I mean, at the time the banks were like, oh, well, we're protected. We don't care if that mezz behind us fails. If it gets taken out, what do we care, right? But I mean, there's some legal stuff. I mean, if the mezz lender forecloses, then everyone else has to get involved and it becomes a foreclosure for everybody. So it's a big pain in the neck, even if the senior lender is protected. Ultimately, they don't want to go there at all, right? But that aside, like they were like, that money. So if the mezz was foreclosing and then it was getting wiped out, well, that meant that whoever was lending the money to the mezz lender was getting wiped out. Right. And ultimately it was coming back to the banks in some way or another. Now we don't have that, right? And we have this preferred equity stuff, which is mezz-like, and it's got its own sort of dangers attached to it. But I don't think it's quite as much of an issue sort of systemically as the mezz debt was, where they were simply just like taking a float, on money that they borrowed. So they were borrowing it, at 3% and lending it out at 10 or whatever, and just taking the spread. So
when I look at this situation, and again, a lot of people are coming at this seeing they're to your earlier point, right? They're kind of fighting the last war. A lot of people are calling banking crisis 2.0, bailout 2.0. And I got to tell you, I don't see it. I see plenty of pain. I see plenty of losses. I see people getting hurt and never coming back. So it's going to be painful. But the brunt of that won't be banks. It might even prove to be a fart in the wind where, yes, they'll take some haircuts. I mean, I go back to that Houston deal that we've talked about. $100 million of equity was blowing out in 11 months. The bank took like a 15 or $18 million haircut. Now that's not nothing, but that's what loan loss reserves are for.
Yeah.
Right. So yeah, it's
Yeah.
not going to be a bailout 2.0, I don't think.
Yeah. And obviously there are going to be, there are going to be individual banks that had lent out too much to certain, the same asset class in the same market. And there will be some of that for sure. But again, systemic banking crisis, I don't see it, not from real estate anyway. Right. And even all the high profile bank, collapses that we saw several months ago, it sort of, like then nothing happened. Right. I mean, where everyone was waiting for like the end of the world to happen and then nothing happened. Now, maybe there's rumblings beneath the surface that you and I don't know about, but it seems like that was contained. And
I just on that front, I've talked about it a bunch. I think we're going to repeat what kind of the S&L crisis is. And the S&L crisis, simply said, was two things in my mind. One is it was a multi-year event. And two, we had a lot less banks at the end of it. I think both those things are true.
Interesting. I mean, that raises a whole other issue. I mean, these kind of, smaller community banks are really important. And if they go away, I mean, that's going to, you want to talk about what's going to hurt smaller investors. I mean, all you guys listening to all this, it's those local banks going away that's really going to hurt us.
I on that front, I mean, I'm always open. I have let me make sure this is right. No, I have. So of all my larger multifamily stuff, 90% of it's financed with local community banks in the Central Valley. Only one of them is at a quote unquote, big bank. So yeah, you're absolutely right. That will impact small business. That'll impact local investors. It'll be a problem, but nonetheless, I think what we're repeating is S&L like savings and loan crisis, where it's years in the making, not weeks, months, or quarters. And we will have less banks, and we may have statistically relevant less banks. We're talking 20, 30% less banks, and they're going to be forced shotgun marriages like we just saw between PacWest and Bank of California. It's going to be a lot of people that are forced to be married. So at the end of the day, Jonathan, thank you for having this conversation. Where can people find you?
So please come by Apartment Investors Club, either on Facebook or on the web. On the web, it would be apartmentinvestorsclub.com. I've got a great free download you can pick up there and get on my email list. And if you're interested in investing with me, as many of you from this community have done, come to Two Bridges Asset Management. Just Google us, and you can fill out the investor form and get me on the phone to talk about multifamily if you like.
There you go. Thank you so much.